So you live in Europe. You've got some cash just sitting in a bank account, and you know you should be doing something with it. Well, you're in exactly the right place. Over the next few minutes, I'm going to give you a super simple step-by-step guide to get started with investing. No jargon, no nonsense. Let's just dive right in.
Okay, first things first. We have to talk about a problem that every single person with a savings account has, whether they realize it or not. There's this quiet, invisible force that's making your hard-earned money less valuable every single day. And that force is called inflation.
I mean, this slide says it all, right? Inflation is just a fancy word for stuff gets more expensive. So that 1,000 euros you have in the bank, yeah, it's still 1,000 euros, but what it can actually buy you in the real world, its purchasing power, is shrinking. The only way to win this game is to make your money grow faster than prices are going up.
And this is where investing shows its true superpower. Let's say you saved 1,000 euros every month for 25 years. You'd have 300,000 euros. Not bad, but what if you invested that same money? Well, with average market returns, you'd be looking at over €1,000,000. That's the magic of compounding, what Einstein supposedly called the eighth wonder of the world.
So, how do we get started on that path to $1 million? The very first step is making sure you choose the right vehicle. You have to understand the huge difference between a real investment and just a flat-out gamble, because trust me, they are not the same thing.
Think about it like an airplane. A speculation, like gold or crypto, is a single-engine plane. The only way you make money is if the price goes up. That's your one engine. If that engine fails, you crash. But a true investment? That's a twin-engine jet. One engine is the price going up, but you've got a backup, a second powerful engine called cash flow. That's money the asset pays you just for owning it, like dividends from a company or rent from a property.
Now, the two most common twin-engine investments are real estate and stocks, but they are totally different beasts. Owning a rental property is like running a small business. You're the one fixing toilets at 2 a.m., you're chasing down tenants for rent, it's a job. Stock investing, on the other hand, is genuinely passive. You buy a piece of a business and thousands of smart people go to work every day trying to make you money. Elon Musk is not going to call you in the middle of the night because a pipe burst at the Gigafactory.
Okay, so stocks are the way to go for a passive approach. Awesome. But that leads us to the next massive problem. There are thousands of stocks out there. How in the world are you supposed to pick the winners? And this, right here, is where most new investors go completely off the rails.
And this chart shows you exactly why. The data is, well, it's pretty shocking. Over the last century, more than half of all individual stocks have actually lost money for investors. And get this, a full 11% of them went to zero. Poof, gone. Picking stocks is, statistically, a losing game. So you might be thinking, wait, if most stocks are losers, how does the market go up? Well, it's because the winnings are unbelievably concentrated. Out of 26,000 stocks in the US market over a 90-year period, just 83 superstar companies, 83, were responsible for half of all the wealth created. Trying to find those 83 stocks in advance isn't just hard. It's like trying to find a single needle in a haystack the size of a continent.
This sounds impossible, right? Like the whole game is rigged? But here's the amazing news. There is a solution. It's so simple, so powerful, that Warren Buffett himself says it's the best path for pretty much everyone. It's a way for a normal person, a know-nothing investor, to beat the pants off the pros.
And this brilliant solution comes from a guy named Jack Bogle. His idea was a total game changer, and it's built on a simple premise. If it's nearly impossible to find the winning needle in the haystack, why not just buy the whole haystack?
And that is exactly what an index fund or an ETF, which is basically the same thing, does. It's one single investment that automatically buys you a tiny slice of hundreds or even thousands of different companies. You buy one share of an index fund and boom, you own the entire market. You're guaranteed to own all the big winners without ever having to guess which ones they'll be.
And the results, well, they speak for themselves. It's not even a fair fight. Over the last 2 decades, these simple, cheap, buy-the-haystack index funds have beaten 90% of the expensive, so-called professional fund managers. Let that sink in. By doing basically nothing, you can get better results than 9 out of 10 Wall Street pros. It is the smartest, simplest way to build wealth.
All right, so you've got the strategy, buy the whole haystack. But how do you actually do it from here in Europe? Now we get into the practical, nuts and bolts stuff, the tools you need and the specific traps you need to avoid.
So, first up, you need a broker. Don't let the word scare you. All it is a company that acts as a middleman. Think of it like a supermarket for investments. You open an account on their app or website, and they connect you to the stock exchange so you can start buying. Simple as that. Now pay attention, because this is a question that almost no beginner thinks to ask, and it can cost you thousands or even tens of thousands of euros down the line. What happens if 5 years from now, you've built up a nice portfolio, but you decide you hate your broker and you want to leave?
This is the crucial bit. Some brokers, like DeGiro or Trade Republic, let you transfer your investments out to a new broker, no problem. But others, like Trading 212 or eToro, trap you. They don't allow transfers. Your only option is to sell everything, which can trigger a massive tax bill on all your gains. For me, this is a non-negotiable, absolute deal breaker.
And here are just a few other quick landmines to watch out for in Europe. Some brokers push these things called CFDs. They're basically complex bets, not real investments, so stay away. Also, you know those famous American ETFs like VOO or SPY you see everyone talking about online? Yeah, you can't buy them here. You need to find their European-approved equivalents. And finally, remember that taxes are different in every single European country, so you have to do a little homework on your local rules.
Okay, we've got the strategy, we've got the tools. But there's one last big fear that holds everyone back. What about market crashes? What happens when the sky is falling? The answer is all about understanding the single most important rule in investing: time.
In investing, time is your superpower. It smooths out all the bumps. Just look at the historical data. If you only invested for 1 year, your chance of making money was about 75%. Pretty good, but not guaranteed. But stretch that out to 5 years, your odds jump to 88%. And if you stayed invested for any 10-year period in history, your chance of coming out ahead was nearly 100%. The longer your time frame, the lower your risk.
This is why. This is the perfect analogy. The market is a roller coaster. It is not an escalator that just goes up smoothly. There are going to be huge, thrilling climbs and some absolutely terrifying drops. Your job is not to guess the next turn. Your job is just to strap in, hold on, and stay on the ride until it's over.
So let's boil this all down. Your entire action plan fits on a Post-it note. Number 1, choose a good European broker that lets you transfer your portfolio. Number 2, regularly buy a diversified, low-cost stock ETF. And number 3, the hardest and most important part, stay invested for the long haul and just ignore all the day-to-day noise.
And that's really it. By understanding these simple principles, you honestly know more than 90% of the people out there trying to figure this stuff out. You have the blueprint. You know the strategy. The only question left is, when are you going to start?